Welcome out to another Trading Justice podcast. Excited to be here ahead of Christmas with my brother Matt. A little sleigh bells and rate spells. Going to discuss the Fed. Going to discuss the Tackle 25 at the end of the webinar. We're going to break it all down for you. I'm excited about the Tackle 25, the release of this. I'm excited because I'm going to see you work your butt off for 3 straight weeks, deep dive into analytics, and I get to reap the beneficiary rewards of that, Matt. And you are going to share with everyone here coming up in a couple weeks, December 30th. I guess it's not even a couple weeks. It's a week and a half on December 30th. Discuss covered calls, discuss the Tackle 25. We're going to talk more about this. I got some questions for you at the end of the podcast, but talk to me about this upcoming webinar.
Yeah, at this point, I would just like to invite everybody to the Tackle 25 Covered Call Master the Income Strategy webinar on December 30th, 8:30 p.m. Eastern Standard Time. And we're going to talk about the Tackle 25 system. We're going to talk about covered calls and at Tackle Trading, 2025's the year of cash flow, in our opinion. And so it's our job to maximize cash flow. And so we're going to be talking about specifically the covered call and the Tackle 25 system on December 30th. And then for the pro members, on the first Tuesday of the year, we're going to actually meet in the coaches show, which is for the pro members, and go through all of the Tackle 25, the watch list, the different list, why the stocks are on that list. I'm going to walk them through the actual scoring system of how we kind of rank all the stocks in the market. And very exciting. And yeah, Tackle 25 is one of our core lists that we work off every single year. It's been this is now going to be the 10th year of the Tackle 25 in 2025. We started in 2015, and so we're way excited for the decade of the Tackle 25, and quite frankly for the future of the Tackle 25. So definitely come in if you're interested in learning about the covered call, if you're interested in learning about cash flow in general, fantastic. Come join me on December 30th. But the Tackle 25 is not just covered calls. These are the best combination growth value stocks in the entire marketplace, diversified from a sector perspective. The list is far more than just a covered call list, but that's the system we bank it on. And it's a wonderful strategy, and we love the list. And very proud of it as well. And so I know we're going to be talking about it at the end of the podcast, so I'll kind of let it go at that point. But if you're interested in learning more about covered calls, definitely December 30th, covered call, come join us. Links in the description.
Yeah, I know you could talk about it from now to the end of the podcast.
I really could. I'm almost all my interest in research.
Yeah, all my spare time with Matt these days is on, all right, what do you think about this? What do you think this, as he goes through the process of fine-tuning, perfecting, which we all do as traders, as investors. We're always fine-tuning, perfecting. And I got some questions along those lines at the end of the podcast. But Matt, do you want to hear a song?
Sure. Always good for a song.
Bears were out there. They were pretty giddy, you know. Doppler falls. Are you listening? J. Postings. Your calls are glistening. It's a beautiful sight, not a bowl in sight. Welcome to Wednesday Sell-Off Land. Wednesday was listen, Bears had a day, so let them have their merriment, right? Bears are a special creature. Let them have their moment. But it was not boring on Wednesday afternoon. Big, huge selling pressure in just about every asset class. A classic correlation of one day where selling pressure starts, it becomes heavy, and it hits everything, right? That's, it was a classic, just everything went to a correlation of one type day. Now, Matt, this big red candle that we have, I have another big red candle song, but I'm not going to give the Bears more than one Christmas present today. It was spurred from the Fed upon their announcement and then continued as Jay Powell spoke. And so I want to spend some few moments breaking down on two fronts. What was said, what was released by the Fed, did the market get it right, and why did they react the way they did, right? I think there's a couple parts to analyze here. Would you agree with that?
Yeah, the most important thing is, what did the market do? That's the most important. But it's also important to understand what the Fed did. The debate on what they got right, what they got wrong, who knew what, that's very entertaining, and I wouldn't exactly call it vital for the market though. Understanding the technical condition, what you need to see next, I would certainly consider vital. But at the end of the day, the Fed, in terms of what the Fed did, they did a couple different things. But in the December meeting, the Fed usually does three basic things. Number one, they're going to announce monetary policy. Number two, they're going to basically go over the summary economic projections, where labor is going to be, where the GDP is going to be, both in terms of the short term, in terms of the long term. You think about that. The SEP is basically a guidance report out of the central bank, kind of like, Micron came out this week from an earnings perspective, and they lowered guidance. Well, when they lowered guidance, what did the price do? It got lowered as well, because what is Micron saying for the future? We're not going to be doing as well in the future as we thought we were going to be. That has to be priced in. You see the same thing here from a SEP perspective. It's the guidance report from the marketplace telling us what the Fed believes is going to be the situation from a labor market perspective, from an inflationary perspective, from a overall GDP perspective, and then obviously the dot plot goes into there as well. And so the December meeting is far more than just what the interest rate is itself. And that's the first thing that the Fed did, obviously, is they lowered the interest rate by 0.25. They brought it down into the 4.25 to 4.50 range. That is the third consecutive cut that we've seen out of the central bank. That might be the last cut we see out of the central bank for a little bit of time here, because of what transpired from a summary of economic projections, the dot plot, and then how Jay Powell spoke about the future. And so when you're looking at the SEP, for example, what really changed from a GDP perspective was the GDP looks really good for 2025, really kind of 2026, but longer term, we saw a little bit of contraction down to the 1.8% expectation. And if you're looking at the federalreserve.com monetary policy, FOMC SEP from December 2018, which we're looking at here on the screen right now, you'll see that as GDP sets forth in 24, we're looking for a little bit of expectation that the economy slows down a little bit. Not much. Powell was not nervous about the economy. At least he did not sound nervous at all about the economy. But from a longer term projection, the market looks at that and says, okay, economy is going to be doing a little bit worse longer term than what we anticipated. All right, that's number one. Number two, then you kind of look at it from an inflationary perspective, right? And so the summary of economic projections gives us GDP, gives us inflation, and gives us the labor market expectations as well. And again, say what you will about any projections out there. You and I are going to be doing projections next week for 2025. Out of everybody's projections, I would say the central bank is probably the best at projections. They're not easy. I'm not saying they're accurate all the time, but they're probably the best at it. They have the most information, and quite frankly, they can push money around. When you look at the PCE report, and which is the preferred gauge of inflation out of the central bank, you really, and this is where the concern was, is that you started seeing double, triple dip inflation set in, and you started seeing inflation get really, really, really sticky around the 3% level for core, 2.5 to 3% for non-core. The problem with the PC, and not the PCE report, but the Fed's projections, is they now show that they're not going to achieve the 2% by what they expected to achieve it by. And so when you're thinking about the Fed today, they expect to achieve a 2% inflation by 2027. Now, Mark, a year ago, that was by the end of 2025 going into 2026. Now we're talking a year more in that conversation. And so the Fed obviously sees the inflationary situation as getting extremely sticky around this 2.5 to 3% level. They're adjusting their inflationary trajectory based on that. Now, when you see that, the market participants have to figure out what they're going to be doing from an overall interest rate perspective as well. And this is what we call the dot plot. And when you're looking at the dot plot basically suggests how many interest rates we're going to be getting or what the expected interest rate is going to be at certain time periods throughout 25, 26, 27. And when you're looking at the entirety of the dot plot, basically what it suggests is we were expecting 3 cuts this year to alleviate the restrictive territory of the interest rate to be to bring the interest rate back down to a net neutral, where the Fed isn't trying to build an economy and the Fed isn't trying to, break down an economy. They're basically saying at net neutral, which is right around 3.25-3.35%, we want to be outside of the impact on the U.S. economy. Right now, they're in restrictive territory. And so what we've seen is now the market expects now not 3 interest rate cuts. Now the market expects 1, maybe 2 max next year, given where inflation is. That's basically what we saw coming out of it. So at the end of the day, Mark, why we saw that big old red candle coming on Wednesday is because the market got a little bit spooked and got a little bit surprised, and they were not prepared, quite frankly, for what the Fed was going to do on an interest rate, not on the interest rates side of the equation, but on the dot plot perspective. And that's where I get a little confused, quite frankly. And I get it. Not everybody's a Fed hawk out there and a Fed watchdog. I get that. But these things were widely discussed by the market, by the Wall Street Journal, by Nick Timmerose.
I think it's important. Yes. Like, not only we're heading into this meeting, and this is, I think, part of the surprise of the magnitude of the candle. I have some theories on that I'll discuss here in a second. But heading into the meeting, the FOMC rate cut odds had already fallen pretty dramatically to only be pricing in around 2 cuts for next year. Nick Timmerose, the Wall Street Journal, we commented on this last week. We commented on this early.
We talked about this literally last week in the pod,
where Nick Timmerose, the Wall Street Whisperer, basically said, you're getting a cut this week, but that might be
the last cut for a while.
Right? That might be it. So this was telegraphed both by rate odd markets. Nick Timmerose should not have been shocking. There was nothing particularly shocking. Little bit surprised that their inflation, they admit that it's going to take longer to be an inflation. Not surprised by the dot plot. And we had a classic case of J. Powell BS by the financial media. Price was down. So apparently J. Powell was the biggest hawk on the planet on Wednesday because price was down. That was not my read on J. That Powell. Was not my read. You and I have discussed this between Tackle 25 conversations. This was neither one of our reads. What was your read on Powell on Wednesday?
I thought Powell was very balanced. I thought
absolutely.
I didn't find him to be too hawkish, too dovish. I thought he was very analytical. I thought he was very balanced. I thought he talked actually fairly positive on the U.S. economy. I thought he sounded positive on inflation as well. He sounded downright bullish on the U.S. economy. Quite frankly, he did not have concern over the labor market. He said yes, and the thing about the labor market currently sitting at 4.2 unemployment rate. Say what you will, Mark, but labor was not supposed to be at 4.2 by the end of 2024. Labor was supposed to be imploding, if you think about this conversation a year and a half ago. And so Powell was, I felt Powell was a little bit celebratory regarding the labor market. And he made a comment or two regarding how the labor market has held up vastly better and that they have zero expectations that they're going to see a labor market implosion here, which obviously had been a concern with everybody and their dog 2 months ago, acting like the Psalm rule is now the end-all be-all of economic projection tools. But at the end of the day, Mark, my read on Powell was not look out below at all. In fact, I was a little bit surprised as we were kind of looking at the price action on Wednesday. You look at it on the 15-minute chart, it never had a bump. I mean, never had a bump, never had a bounce.
And let me bring in a stat for you here on the magnitude of that. Note out of Goldman Sachs, right? Because we talk about market reaction and this and that. This might have been just a short selling stampede. I'm going to give you a stat from Goldman Sachs, Matt. The short selling in the time right before this and on Wednesday was in the 100 percentile over the last 5-year look back. Like short selling was absolutely off, at the higher ends of the extreme. This might have been just a good old bearish stampede, right? Short selling, and bulls not prepared to mount a defense. And it just took a life of its.
You're telling me that somebody loaded up on short selling and put options to the point in front of the Fed?
In front of the Fed, and while the Fed meeting was occurring.
This is amazing to me because, Mark, I've watched the Fed probably as closely as anybody else in America in the last 15 years. And there were numerous times in the press conference where I was genuinely surprised the market wasn't bouncing based on what Powell was talking about.
Mm-hmm.
Because the immediate reaction was down from the very second the Fed released to until the end of the day. It was down. The immediate reaction was down. The secondary reaction was down. When we got into the press conference, there were certain questions on labor that I felt like market's gonna bounce here based on that.
Matt, I am 100% with you
about the economy. I was like, market's got to bounce on that.
We have watched, I believe, every word Powell has spoke the whole year long. We haven't missed a syllable if Powell has spoke. This was not a terribly different Powell than I've seen.
This was abnormal. This was abnormal. The market response.
The market response wasn't abnormal.
Not Powell. Not any of that. That's cookie cutter stuff. And that's the crazy part is I do believe it was cookie cutter stuff on Wednesday, but the price action was anything but. And if people are loading up on put options and short selling and the bears, that feels like that's a washout.
Yeah.
Hunt stops, clean it out, clean up the overextension, reset the technical condition. This is not the start of some ultimate bear market.
Boom, right there.
It's just a wipe out reset condition. That's what my read would be based on the totality of the evidence, in my opinion.
And that too. And let's get into the technical discussion now, because I have the same conclusion you did. I did not share that stat with you before the podcast.
No, you did not.
I wanted to see because it's important, because I wanted to see if your analysis was mine as well. Because if that is the case, and we know from Goldman that is the math of the short selling. Front running, put buying, downright short, accelerating Wednesday. That sets up some ammunition to clear out if we can get some technicals. We've seen this song and dance before. The tough thing about being a bear, and in all seriousness, is you have to be right. You have to have the narrative.
You have to be in front of action, and that's really, really difficult to do. It's easy to look back, right? It's easy to look back and be like, ooh, we should have loaded up on some put options on Wednesday morning. Well, would-haves and could-haves and should-haves. But
were you feeling that Friday, and are you going to feel that on a big green candle on Monday? No, all of a sudden. No. And that's the difficulty of bears. There's no conviction. When bulls buy, they'll sit through some intense pain. But until the dynamic of bears change, bears don't sit through that pain. If they don't get it right, they run. We've seen it happen for years and years.
Well, number one, they're not convicted. They don't have conviction, number one. And number two, let's face it, there's a lot of rules built for the bulls, and they know it. And so they got to pick their spots, and they can't hold on to a trade in the same.
You and I are not perma bulls like Tom Lee, who's going out there and telling you to buy every dip. It's like Tom Lee, he said buy this dip, buy that.
As a bull, we talk as bulls in the podcast, but
we do tend to lean on the bullish side because most of the time that's where it leads you, right? Yeah. That's where it leads you. And, I enjoyed reading the newsletter. I always enjoyed reading the newsletter, your technical section, Matt. And you talk about, there's some different aspects you talk about here on what to look for. You kind of talk about this pivot versus consolidation in this general reversal context. And, and then you discussed in the newsletter kind of how there's certain areas of the market that need more work than others. Mm-hmm. Will you summarize and break down this technical conversation, because it's going to be a really important one in the coming week?
Yeah, honestly, Mark, when I was writing the newsletter yesterday, and the two I kind of write the technical update, and the earnings update, and a lot of the sector stuff, and then you write the economic update, the global markets update. Coach Frank, Coach Greg, they handle a lot of the traders report stuff. We do videos in our newsletter, we do videos in the traders report, you name it. But I honestly had a difficult time trying to figure out how I wanted to message the technical side of the equation. And I spent a good 3-4 hours just staring at my writing there yesterday. But I had a specific message I wanted to get across, but I couldn't figure out the best way to tell that story, if that makes sense. And so I've tried to figure out a couple different things. I had some weird analogies going in the newsletter yesterday. You should have saw some of them. But at the end of the day, the way I see the market is through the lens of pullback analysis versus end of trend analysis versus what do we need to see, right? And so basically what I was talking about in the newsletter, and I'll just kind of talk about it here on the indexes, is when you're looking at, say, the Qs, for example, the NASDAQ, you look at this as a bullish uptrend with a higher high and a higher low. And just from a pure technical perspective, that's how you see it. You don't see this as the end of a trend. You see this as a bullish uptrend with a bullish retracement in between the rising 50 and the rising 20, which is that kind of last zone of support in the depth of the retracement type conversation. You would be looking for a king's bed type consolidation to really alleviate the volatility pressure and align intraday and daily timeframes. That takes 3 or 4 or 5 trading sessions usually, but it doesn't take a lot of time. You're really just looking at this in the NASDAQ specifically as a depth of the retracement conversation. Whereas when you're looking at the S&P is like that middle ground child right now between the cyclical indexes and that of the growth indexes. So you have the Qs, which is the growth index. You have basically the IWM diamonds RSP, which are your cyclical indexes. And then you have the spiders here. And the spiders is like the middle ground because it represents the heavy weight of the Mag 7 components, but it also gives you a bunch of the cyclical and defensive ones as well. And so you look at this and you look at this as the ending of a trend. It broke the 50 period moving average, high bases turning into retracements that violate 3 different moving averages simultaneously are not retracements. They're not pullbacks. They're something else. They're in that consolidation neutral type situation. And it's really not giving you a good read right now on the S&P because what the S&P is showing you is the NASDAQ, which is still doing really good, and all those cyclical indexes that are down low. As you see, the diamonds gave up even more last week. IWM gave up even more last week. Near the 200-day moving averages, IWM, RSP, which is another, one of the cyclical indexes that matches equal weighted S&P near the 200-day. These are not pullbacks that we're looking at. They were pullbacks before this week, but they're not pullbacks any longer. And so you can't just treat them as, oh, let's buy the proverbial dip, because the only thing you're going to do is run into a buzzsaw called the 9 EMA. And so the path I took in the newsletter was looking at the different indexes and detailing specifically what you need to see to build confidence in as that bull. And so, at the end of the day, when you violate support, pattern, and trend simultaneously in a singular movement, that's the ending of that trend at the end of the day. That's the end of the trend, which means you have no probability right now as a bull. Looking specifically at the RSP, diamonds, IWM. Does that mean this doesn't lead into a really good buying opportunity? It probably does. It probably does. But the thing about it is you don't know that right now, Mark. I don't know that right now. And neither does anybody watching or listening to this podcast know that right this very second. So on the Qs, you look at it as a pickup situation with a little bit of development. On the cyclical areas of the market, that's not the conversation. The conversation is you need to see reversals here. you have a short-term downtrend. You can't not see that. You have violated support. You are now forming a lower level of support. You're going to form a lower level of resistance. I guarantee you are, because Mark, if you don't, you're going to V-shape all the way back up. And I just don't feel that's going to happen after legitimately like 3 straight weeks to the downside. That would be abnormal to say the least. So the most likely scenario is you're going to form a lower level of resistance as people who, quite frankly, got beat up last week and the week before look to unload positions. We haven't went through that. And so, Mark, the thing about it is what's going to happen is as the market goes back up, form bearish retracements, that's going to give people an opportunity to unload positions.
And it feels like that's the next stage of the saga.
But
sometime
hold
soon.
on. But if you understand the detail and the patterns that happen within the construct of a reversal formation, that is the next pattern that occurs. You go through a bearish retracement. That bearish retracement oftentimes sees a downward pressure in price because people want to unload or double up on the put options. Then support holds and you start getting into reversal formations. And so the market right now and I said last week in the newsletter, it's complicated from an environment perspective. There's a lot of complications and difficulty in the market right now, but it has not been complicated in the price action. And that's how we have been looking at this for the last 3 weeks. 2 weeks ago, it was, okay, we got to see pivot formation on RSP. We got to see a breakout on the S&P. Last week, it was, all right, we got to see a king's bet on RSP. We got to see the development of the consolidation with confirmation above the 20-period moving average. We didn't get that. This week, we're saying, okay, now we need to see. And so it's a technical story being told very cleanly, in my estimation, from a technical side of the equation. I know the fundamental, the economic, the monetary, the geopolitical, everything else is complicated. But from a technical perspective, this one has not been complicated. Yeah, it's been a story we've told very, very specifically in the newsletter over the last 3 weeks. It's a story we've been navigating our community with. And yeah, were we looking to be buyers at the 20? Yeah. Were we looking to be buyers at the 50? Yes. Are we looking to be buyers in a reversal? Yes, but only with confirmation. Well, and that's the key point here.
The nice thing that the downtrend in basically everything else has done is it has never tempted you.
It's never sniffed confirmation.
It was like there was never that 2 days, 3 days, like, oh, it just never tempted you. It was a straight.
I don't want to say thank you to the market for being an asshole the last 3 weeks, but I do want to say thank you for not confirming on a breakout and getting everybody involved aggressively in front of something like this.
Yeah, and so now, and now it is, and will you give me the one thing you pointed towards the April, and we give me the S&P 500. Like, sometimes when we have it in 2024, gotten, and we go back to April for me, like, there's a couple formations I'm looking for. Like the most beautiful formation would be something that, trades sideways after the sell-off. And you pointed to this, you already had it highlighted for me. Thank you very much on that.
I had a screenshot in the newsletter yesterday. So.
Yeah. So trade sideways in the cyclicals, right? And I'm not looking on the S&P for this formation. I'm looking in cyclical stocks where bulls earn it, right? We've seen these patterns in in selling conditions. We saw this in December of 2022. We've seen this in points in 2023 off sell-offs. We saw this in April where you have a pullback, you have a sell-off, and bulls just genuinely earn it. Like, all right, let's stick it. Those puts bleed during that time. And then upward momentum really finishes off the bears in those environments. Is it too much to ask where, Matt, we're heading into a holiday season, lower trading volume, right?
No,
not a lot going on.
It's not. Coach Frank always says this. You can only ask, right? You can only ask. I mean, the market doesn't have to behave it, but it's not too much to ask for consolidation after a lot of volatility. No, that's not too much to ask. In fact, I think that's exactly what you need to see, because, and I give this analogy all the time, Mark, but when you violate a support level, whether it's the 20, the 50, horizontal Fibonacci, I don't care. But when you violate a support level and the volatility ensues, It's like that dam breaking and the water rushing out. It's scary. It's overwhelming. It's nerve-wracking. You know there's damage there. You know there's concern there. You know there's fear there, but you don't know what the extent of all of that is. You just know it exists, right? And the same concept happens when support gets violated, because what's immediately under support is stop losses. And when those stop losses get triggered by the algorithms, it creates a volatility condition that you don't know specifically where the next direction is. And so what you need to see is you need to see consolidation, because what that consolidation does is it alleviates the volatility and allows us to see what the clear patterns are. What is the real support levels? What is the real resistance levels? And I love the call out on the April timeframe, because it's really behaved very, very textbook like, in my opinion. When you're underneath the 50 period moving average on the daily chart, that's the end of whatever trend. I don't care how, whatever technician you are,
whatever it was.
Yeah, because everybody can parse technical data differently. But at the end of the day, I think we can all agree that if you violate the 50 period simple moving average, and the average price over the last 50 days is now, the price is underneath that, you don't have a bullish uptrend. Can we just agree with that in the short term? Right? Okay. So I think that's a pretty universal thing, is when you're underneath the 50 period moving average, that's kind of that last support level that stops any bullish uptrend from becoming something more than what it is. And so you want to see reversals when you're underneath the 50. It's a pretty standard ask by any technician. And so you obviously were underneath the 50 here. And then, Mark, on Friday, it tested the 90 MA on the daily, came right back down and pegged itself to the 50 period moving average. And so when you're looking at that case study from last time, it took a little bit more time to get underneath the 50, Mark. We didn't have that here. We had a high base for 2 weeks, which brought up all those shorter duration moving averages. It then turned into a retracement, which means it just so happened to violate every degree of moving average in one simple move to the downside. So you don't have that trend when you're underneath the 50. You have to see something more. When you're looking at the Qs, for example, once again, you're above the 50. It's a different conversation. S&P, you're underneath the 50. Diamonds, you're underneath the 50. IWM, you're underneath the 50. RSP, you're underneath the 50. What do you need to see? You need to see reversals.
Yeah, you need to see reversals, and we'll be tracking that pattern development, know what you're looking for. And when it goes, take advantage of it. And then in the meantime, Matt, I know from existing positions I have, to, get covered calls into place, right? Get cash flow working, that if we do have consolidation or extra pressure, right? Well, that cash flow helps me manage my portfolio. We'll talk more about the Tackle 25 here in a second.
My one last thought, I said it earlier, I just want to finish on it, because we've been talking, Bear, what do you need to see? I think at the end of the day, I see the Fed on Wednesday as a very similar way as I see earnings oftentimes, where a lot of bad things look, sales programs happen, violations of support occur, people get concerned, everybody starts talking about the what about this and what about that and what if scenarios. I see it as a technical reset. That's how I personally see it. And I believe the market's going to see that as well. I think we just wait on those next technical patterns here.
Yeah, and the only way, and we give me the dollar chart, Matt, just head into some global market discussion. The only way I will turn really macro bearish is if yields and the dollar get unruly here, right? Now, at the end of the week, the market
kind of already unruly, but I get what you mean.
You know what I'm saying,
yeah,
right?
I get what you mean, but
you get what I mean. Like, at the end of the week, market ended the week on a positive note. We've had some hotter inflationary data. We've talked about this in the podcast over the last month. We've talked about it in the newsletter over the last month, right? Well, on Friday, we had kind of a break of short-term trend. It was one data point, but listen, it came on the right day for bulls. Well, it came on the right day for bulls when the core PCE price index, which is the Fed's favorite, we call it the market's third favorite, but it is, labeled the Fed's. It's an inflationary data point, right? Came in at, missed, just outright miss. Missed on the year over year, missed on the month over month. And boy, the market was set up at a teetering point. Futures were down, ended the week on a positive note. The government shutdown that was being discussed on Friday, avert that. So there was some positive vibes.
They didn't know it was getting averted before it got averted when the market closed. I just want to be clear.
Right, but heading into Monday,
the reason I say that is because it fascinates me that the market did not care one iota about the government potentially shutting down, and they didn't. The market could care less. We didn't talk about it one time at tackle trading all week long, and that amazed me that in a hypothetical government shutdown, the market.
Well, and this is why bulls cheat. They don't care about it, but when the bad news is averted, they celebrate it.
That is usually
we've seen that. Like the crisis that wasn't priced in gets a bump, you know, and so there's some positive vibes on the inflationary front. And most importantly for me, yields. The 10-year yield had a 2-week stretch that you don't see very often. The dollar was breaking out. Having a little cold water thrown on those two charts to end the week, right, probably keeps them in check in the holiday season. We'll see what the technicals, bring out. But if they can keep in check, we say this all the time, it is, if they're not moving, right, they're not stories. It's when they're moving and, that they're stories. And so, technical landscape thoughts on the dollar right now.
Nervous on the dollar. I think for the market to find some footing here, we cannot see yields in dollars go up.
Can't.
And for me, that's the concern right now. That's probably the number one concern right now is how does the dollar behave? How do yields behave? And right now, dollar broke out. And there's two things really driving this dollar right now. It's not just the yield conversation. The U.S. economy is doing very well in comparison to the counterparts. Very well. GDP at 3.1%. That came in above the expectation of 2.8%. That was the final GDP that came out on Thursday. And then you obviously had a little bit of a bump down on the inflationary side of it. But inflation has been a double dip concern over the last month and a half, maybe even 2 months, a little bit from a data perspective. So it's really the health of the economy, a little bit of inflation, but none of it spells doom out there, right? From an economic perspective. And that's kind of what Jay Powell said as well. But
and that's where
I'm nervous about the dollar a little bit. Yeah.
And it's certainly something, and that's why maybe I'm tactically looking for opportunities more than I in the coming week, just because you had and on a positive. And I know when bears load up on shorts, if Armageddon doesn't come, heaven help you get a positive data point like the core PCE, all of a sudden we've seen those dynamics play out. Now, I hope they play out in some consolidation, right? I hope they play out, and that's how it plays out over the holiday season, because that will provide a lot more opportunities at the start of the year. But monitoring these charts, Matt, without a doubt in 2025. How do you not?
Well, of course, anybody that doesn't monitor the dollar chart, I would strongly recommend you start monitoring the dollar chart. But that's all I have to say on it.
Yeah, and then we saw this volatility in this, on Wednesday. We saw it in gold, we saw it in silver, we saw it in Bitcoin, we saw it in Ethereum. You go through. Crude oil is the only thing that didn't care, right? Crude oil just trades in a consolidation pattern from now to the end of the time. It doesn't really.
Listen, but here's the reality, Mark. The conversation we had on the S&P regarding the Fed, we can rinse and repeat and talk about those commodities. It's the same conversation, though. When you have a sell everything moment and it's based on the dollar and yields, everything includes stock and commodities. It's the exact same conversation. The only difference is technically what are you going to see next on gold versus silver versus copper versus the crypto space. Obviously, everything got caught up in the volatility. What's going to look better is going to be based on pattern development. Some areas, like the index conversation, some areas are going to need a little bit more development. Ethereum is going to need a little bit more development, quite frankly, than say Bitcoin's going to do. Bitcoin's going through a bullish fake out situation. Ethereum has a double top, double bottom, and now is sitting at the 200-day moving average with volatility. These are technical conversations. And so if you're interested in finding when the specific moment to pick up one of these asset classes is, I would strongly recommend getting into the Traders Lounge, because I am not going to do a deep dive on every asset class in the podcast.
Yeah, and the one thing that I really enjoy coming off volatile, these little flush moments, is not everything usually sets up at the same time, which from a trading perspective allows you to focus on what is, right? Direct your energy there. And you don't have to
I'll
make.
tell you exactly. Yeah, of course. Gold and Bitcoin is going to set up in front of Ethereum and silver. That's going to happen. I guarantee it will.
And then in equity markets, different sectors, you're going to see sectors.
That's not a new conversation. That's an old conversation. It's
and these are
new
the
ages,
things
but old analysis.
prepping. All right, let's get to some stocks in the news before I ask you some questions on the Tackle 25.
Sorry to just kind of cut short that commodity, but I'm just like I'd say
it's the same conversation. It's literally cut and paste the same technical conversation. And we'll check in on the Tackle today. Check in on the Traders Lounge. These things, we're going to be ahead of the game as we usually are. Give me Micron, man. A few stories that caught my interest. I was really hoping. Now, I don't have any exposure to Micron. Micron's a sentimental favorite of mine. It's been a while. I was hoping they would deliver a better earnings report. They did not. What was your take on Micron's earnings?
Micron's earnings are really, really simple. They downgraded guidance on both EPS and the revenue side of the equation. They told every investor in the world that they were not going to make as much money next year as they made this year, and that has to be priced into the market. Micron had an opportunity here. I'm right there with you. They were punching up against a multiple time frame resistance level. This is really kind of the number one memory chip stock out there. You can see that, overhead resistance right around 112, 113. They had an opportunity to break back up above that. And now the problem in this neutrality, you're just going to have a hard time finding anything on Micron until you're either going to work a lot lower, and that would include a bearish opportunity. A violation of support here would be really, really, really bad for Micron. And so you're going to have to be looking at that. The bulls are not looking at Micron in the short term. I can tell you that.
Yeah, no, I just, it was one of those that I was hoping it would provide.
Yeah, me too. It had an opportunity.
I've been looking for excuses to do stuff in semiconductors for a while. I just have not found them from a thematic standpoint or that, it's just, I just haven't found one. Even from a cash flow.
Go write a bull put spread on Broadcom.
Now, yeah, Broadcom, which we discussed in Stocks and News last week, is one of the real good ones. I think
that's what I'm saying. I know you don't like to chase, and you would be chasing here, but Broadcom is the best of the bunch right now. From a technical perspective, a thematic perspective, they're a leader here. Semis themselves probably don't figure things out until the market.
Well, and I was going to talk NVDA because that was one of my stock stories.
Oh, go ahead. Sorry to jump. I never know what stocks you're going to talk about.
You never know. But it actually, in the midst of all of the craziness at the end of the week, one of the news stories that got lost in the mix is that European regulators cleared it from recent competition concerns, right? It seems like every story with NVIDIA has been something with global countries. Well, it got some positive.
European regulators only have their pockets out saying, how much NVIDIA are you going to pay us? That's what got cleared. The check got cleared is what got cleared.
And NVIDIA, seeing some short-term support level build. What do we need to see on NVIDIA?
European regulators to go away and never come around.
Well, yes, and that's not going to happen.
Okay.
From a technical perspective,
Chinese relations and China and the U.S. to sing kumbaya. Can that help? That would help?
Yeah,
so China and the U.S. to sing kumbaya and European regulators to kick the can. That would be the two-pronged approach on Vietnam. Kidding. Catalyst. Semis waiting on a catalyst. And honestly, Broadcom probably should have been that catalyst. Broadcom had a wonderful earnings report.
One of the best of the quarter.
NVIDIA didn't have a bad earnings report. No. It had a really good earnings report. I haven't seen negative semiconductor news recently. And you might say Micron this week, but Micron's a memory chip. It's not the exact same conversation as the Broadcoms and the NVIDIAs of the world.
Novo Nordisk, ticker symbol NVO, weight loss drug. Popular, have a couple popular weight loss drugs out there. Disappointing trial results for a new drug caused quite the gap down. One of the things, and it's just a public awareness statement, Pharmaceutical biotech companies, right? You can have gaps out of nowhere that are not earnings related because of the numerous trials and clinical things they do. But weight loss has been a big winner, but that's fallen on
Weight loss
times.
drugs have been a big winner for America. They have not been a big winner for Eli Lilly lately.
Yeah, that theme, that narrative has certainly in recent months lost a lot of steam.
It's lost a lot of steam out of the leaders of the space, though. And why has it been losing steam? Because there's competition coming in. That secondary impact is coming in. Those cheaper solutions is coming in. So it'll be interesting, but I don't know. I don't feel bad for Nova.
Next one, FedEx announcing the plans to spin off its freight business. Saw some volatility on Friday on that, initially up, sell it off, but lowered some guidance over the full year outlook. But whenever you have a company announce a spin-off of a particular business, something to take notice of because it can provide opportunities in different spaces. Go look at GE as a prime example of that. Following those stories, following the technical patterns that emerge after the story, not that day, not that next week. But if you had done that on GE, you would have been in the midst of a really nice trend that done. So I found that very, very interesting news. Any take on FedEx?
Yeah, they also had earnings this week as well. Obviously, they came out and they missed on EPS. They did lower guidance slightly. I think the guidance range was 20 by 21. They lowered it to 19 by 20. So obviously an official lowering of guidance by about 3-4% from the midpoint. And then the freight business was, I saw that as positive. That's becoming a more positive storyline for companies in terms of spinning off different segments of their company.
It is. And I think it's one you have to put on watch list and follow because it can provide a lot of opportunities.
Yeah, we can all thank GE for that one, but it started before GE, but GE did it to a just wide success. In fact, a massive success out of GE from where they were to what they are now doing. So I took the positive. I took the positive on the freight business, but the guidance, you can't discount guidance, and guidance has to be a little bit of concern. In totality, I personally took FTX's earnings as a doji, is what I would have called it. And if you erase that big old volatile candle, that's a doji.
Yeah. And I got a lot of different ones to choose from. I'm going to choose Palantir as my final stock. Announced earlier in the week that it had extended its contract with the U.S. Army, which uses the company's artificial intelligence software to help accelerate key decision-making processes. This is something that you have been on for months and months and months. And you've been like, listen, Palantir, AI, this is a real thing. Jim Cramer calls this a meme stock. Jim Cramer is a freaking idiot. Jimmy Shill, right? Jimmy Shill. But you have been on this for months and months and months, being like, listen, the AI components of Palantir are real. Its interaction with the U.S. government puts it in a unique space. Plus, we love the CEO, right?
And I will give Cramer that. There is a lot of things that people love about Palantir, but I wouldn't put Palantir. I think it's offensive to Palantir to put it in with AMC and GameStop, quite frankly. I think that's absolutely ridiculous. The importance of this company to the United States government, to the AI development, for the United States government to control AI around the world, it's unheard of how important that is. And for Jim Cramer to say this is the same basket as GameStop, are you kidding me? Just based on that alone, people should stop paying attention to Jimmy Shill. But I don't want to get off too much on that tirade. Palantir is one of my favorite stocks in the market. Palantir, their CEO, the importance of this company to the United States government, all of them are through the roof from an importance standpoint. And getting another government contract, I think they've gotten 2 in the last 2 weeks. This is what funds this company, is government contracts. But they're doing a decent job kind of to diversify as well.
Listen, let's finish off our podcast discussing the Tackle 25. I got a few questions for you.
Yeah.
You will be releasing the Tackle 25 here for our pro community in a couple weeks. At the start of the podcast, we talked about the webinar coming up. Just give me real quick, and as we're going to cut this segment, discuss this segment, or someone joins at this segment, just tell me what the Tackle 25 is, like just in the nuts and bolts of it.
Well, the Tackle 25 is the name of the watch list that I put together for the best 25 stocks for covered calls in the marketplace. And that's what it is, just the name of the watch list that I've been putting together for 10 years, called the Tackle 25 covered calls. It's the 25 best covered calls in the market. Now, best covered calls from a fundamental growth, the tackle trading way, is some people might look at a cover call and say, well, how do you define best, right? And do you define best based on the ROI potential? And I would say absolutely not, because you can go out there and find a stock and get 12, 15% on the covered call. And I would say that's way too volatile for the covered call. You're getting paid way too much for that type because you're doing it on the wrong stocks. There's growth stocks out there. There's value stocks out there. There's combination stocks out there. Well, the Tackle 25 is a combination growth v value watch list. I go through 10 different fundamental criterias. There's also liquidity criterias. There's technical criterias. There's diversification criterias. I'm basically building a covered call based ETF here is basically what I'm doing that is diversified. And so, like, can you go find 25 tech stocks to do covered calls on? Yeah, you can. But does that mean we want to do 25 covered calls on tech stocks? No. I want to go get one or two utility companies. I want to get two or three, staple companies. I want to get 4, 5, tech companies. I usually build the diversification over the Tackle 25, kind of fitting kind of how I feel the next year is going to play out from a growth fee value perspective. And so the Tackle 25 is just the name of the watch list. But the stocks that go on that watch list, they have to pass some pretty aggressive rules, I would say.
Yeah, I know. Traders, investors, we are always trying to constantly improve, right? Improve performance, improve how we approach. What are some things, and I know you, and I know you by nature, and I know you practically from following you on the Tackle 25. What are you doing this year to try to take your process of selection up a little bit?
Well, I'm trying to automate everything, make it more systematic, remove the emotional element from the equation. And the beautiful thing about the AI technology out there is it can help me achieve certain things that I otherwise didn't have the ability to do. For example, creating algorithm programs to automatically score based every stock in the market based on my fundamental and value criterias that are unique to us at Tackle Trading. Those are things I couldn't do in the past. So I think the new change this year, and I haven't got into the final conclusion of the Tackle 25, that will occur this week before next Monday's webinar. But I think the number one thing that changed this year so far is just the amount of data that I can look at from a fundamental and valuation growth perspective to really get an understanding of the quality nature of these companies. Making sure that we're not stepping on any proverbial landmines in stock selection here, because I don't want to say a PE ratio can lie, but a PE ratio can lie a little bit. A PEG ratio can lie a little bit. Growth metrics can lie a little bit. So we're trying to figure out, is there any landmines out there that we want to, not step on it, obviously. But, I would say the automation process is probably the number one change. But at the end of the day, I'm always going to focus on the valuation and the growth components. Valuation, PE, PEG, forward PE, price to sales, price to book, those types of metrics. Growth is all based on EPS, last 5 years, next 5 years, this year, next year. Guidance reports. One of the reasons why I cover as many earnings reports as I do is so that as I do come into the Tackle 25, that I have not just a oh, look at these numbers on this spreadsheet somewhere. Oh, look at these numbers on FinViz. But I have an actual understanding of what these companies are saying in their conference calls, in their guidance reports. And so the depth of the understanding is just a little bit different at this point, given the fact that technology has advanced to such a level in such a short time period.
When you identify, my next question is, when you identify a good fundamental company, right? And we've been doing this a long time. You identify a good company. If the company's good and management's solid, that fundamental story tends to last over the year, over the next year, and can last for years and years and years. And maybe not the process, but what is the emotional calculation and maybe some of the, when you've had a stock that has been great, that the fundamental story has been there, but at what point does the valuation level just say, I just can't do this anymore?
I know what you're getting at, but I think you're wrong. You're trying to get to the point of, do I remove stocks I like off the list based on valuation? Of course I do. You have to meet certain valuation criteria, Mark. But the amount of times I've had to remove a stock from a valuation perspective is very, very low. Like, I have not had to do that because the selection process, I do not go through. Like, if you're doing what I'm doing, like, I'm not, that concern you just brought up is not a concern of mine, ever. But I will say this, there has been so many amazing high quality stocks on the Tackle 25 that have went up so much over the years that I can't put them on the list because they are too high of a dollar, not too high of a PE ratio. PE ratios, and again, I want to be very clear on this because I understood your question, but I kind of got triggered a little bit on it, because as price goes up does not mean that is overvalued. It doesn't mean that you now have a stock going from $50 to $100 does not mean it has a higher PE ratio. If that stock is going up based on its earnings growth is going up faster than the price, the valuation actually goes down. And so I get what you're saying, but I'm feeling a little triggered here because then I'm like, you don't think I know how to pick a nice little PE ratio that's not going to go through what you're doing? So I get what you're saying, but yes, I have had to remove stocks simply because they went up too much, but not because they went too high valuation. They were going strong because of earnings growth. I don't just take into account valuation in the Tackle 25. 40% of my scoring system is based on valuation. 40% of my scoring system is based on growth. If I am able to maximize the efficiency of the valuation component with the growth component, the growth is going to take care of the valuation. And so I feel pretty damn good about my ability to do that. I've had 10 years putting the Tackle 25 together. That's not my concern. My concern is these companies go up, I'm going to have to remove them because they're not great from a price perspective on the covered call, but it's not the valuation concern that you think it might be.
Okay. Now we have, you put out a lot of other lists in conjunction with the Tackle 25. Like, what is the, like, some of the process? One of the favorite amongst a lot of traders is the dirty, sexy money, which is high volatility stocks. What are some of okay, this isn't quite a Tackle 25, but maybe it's a better on one of these other lists. What's some of the things that go into that process?
That's why we have those other lists, is because I find a lot of stocks as I'm going through my process, and I don't just want to leave them aside. And so we created dirty, sexy money, which is I put more emphasis on the growth metrics than the valuation metrics on dirty, sexy money, which typically mean also my volatility metrics will be expanded a little bit. For example, on a good Tackle 25 stock, usually implied volatility will max out at 50 and it will bottom out somewhere in the high 20s, typically. Somewhere around 25 to 45 is kind of that implied volatility score on the Tackle 25. When you're looking at dirty, sexy money, those can be anywhere from 30% implied volatility up towards 80, 90% volatility. And so the rules for the dirty, sexy money, because it's a growth list, everything's going to be a little bit more anchored to the growth side of the equation versus the value side of the equation. However, you still have to meet certain valuation components. I just extend them for dirty, sexy money. And on the flip side, take a list like, and by the way, dirty, sexy money is the top 10 stocks for like boomerang strategies and whatnot. But the opposite of dirty, sexy money is the dividend fireworks list, where you have these more value-based stocks that are well past the growth part of their equation. Think about like a Pfizer, for example, something along that. Think about a bank stock that pays a 4% dividend. These dividend firework list, top 10 stocks that are the combination value covered calls. So dirty, sexy money would be top 10 based on volatility plus growth. The dividend fireworks would be the top 10 dividend paying companies that you can do covered calls on. Tackle 25 is kind of that anchored flag based system. But so you have one that's more aggressive called dirty, sexy money, and then you have one that's more conservative called dividend fireworks. And on dividend fireworks, like for example, if you're getting 1 to 1.5, not margin, but if you're getting 1 to 1.5% return on a covered call in a dividend firework, that's good enough. That's good enough because you're also capturing 2, 3, 4, 5, 6, 7% interest rate over the course of the year. And so you're just looking for a little bit of different things there than you are in dirty, sexy money. Usually dirty, sexy money doesn't pay dividends because they're growth stocks.
Two more questions. Is there anything that during your process just surprises you? Could apply to anything.
All the time.
You just, like, just give me an example or two.
There's always going to be a stock in a space that makes no sense in given what the space is. You know what I mean? Like you're looking at basic materials, for example, and all of a sudden you look at a stock fundamentally and it's just like, oh my goodness, that is amazing. I have to do that. But it's usually the space that as you dive into it. One thing that really stands out is certain themes happen every year. And by the way, I'm only halfway through my research. I'm not all the way through it yet. But for example, one thing that I'm finding this year that is a little bit challenging is the current valuations of the market are stretching the limits here. And I don't use absolute numbers, by the way. I know I love Warren Buffett, but Warren Buffett taught us that anything above a 20 PE ratio is overvalued. Anything under a 20 PE ratio is undervalued. Is that true? Maybe. Doesn't it depend on the space, the sector, the industry, and the average PE ratio? So I take into account the sector analysis quite a bit. I think cross comparison against sector valuations is about 40% of the ranking through valuation and growth, quite frankly. But I would say the thing that stands out right this very second is we have a valuation problem in the marketplace right now from a pure PE ratio perspective. PE ratios are elevated right now. And so they're elevated, sectors are elevated, stocks are elevated. It won't impact the creation of the list as much as others might do, because I do cross-sector comparisons, but it is just something to keep in mind on that we are in a general overvalued environment. I'm not talking technically, I'm talking fundamentally.
Final question. Can you give us a taste of a stock on a list?
I don't know if I want to do that yet. I haven't finalized any numbers. I'll show you the list. Like I'm not ready to say one stock's on the list. Like I'm not ready for that. And do I know some stocks that are going to be on the list? Yeah, I of course I do. There's probably 13 stocks off last year's list that are going to be repeat performers on this year's list, because I don't remove stocks if they're still in the proper way, right? But I'll show you. I'll give you a sneak peek though.
Yep, no, that will suffice.
It's kind of at the overall spreadsheet here. Basically, what I like to do, Mark, is I like to look at every stock. So basically, what I do is I download from FinViz all the fundamental data on every stock in the market that has an option that you can trade on it. Now, not every stock is very liquid and all that, but I want to do an entire fundamental breakdown. Now, Mark, one thing I did do this year that's a little bit different is I did a fundamental scoring system. And so I scored every single stock in the marketplace based on from 0 to 100, right? From 0 to 100. And 100 is the top score. So if you meet every single metric, you get 100. That is the max you can do. Harmony Gold is currently the highest rated basic material company. As you can see, the top 5 best fundamental stocks within basic material, they're all gold stocks. And so basically, I'm still in the process of developing the list, quite frankly. And so I don't want to say one way or the other what it is. Top rated consumer defensive stock, LRN. I don't even know what that company is, by the way. Very small company. The top rated energy company, OII, Baker Hughes, slightly underneath that. By the way, anything above 50 is fundamentally strong. Anything underneath 50 is fundamentally weak. And so, no, it's just in the process of going through the selection, but we're not there yet. Now, obviously, are some of these stocks off last year's list going to make it? Absolutely, Mark. Absolutely, some of these stocks are going to make next year's list. There's no doubt about that. There's some of the best stocks in the world on this list. But we'll have the final list ready. The final list will be done by this Friday. And then we'll send the list out to our pro members. And then we'll do the Tackle 25 webinar on December 30th.
Yeah, and let's finish off our podcast. Enjoy the podcast as I always do with you, Matt. Let's finish it off. Give us a few more thoughts on the webinar. Give us some thoughts heading into this
I've given enough thoughts on the webinar.
Well, give us some thoughts as we head into this holiday.
Hit the link in the description below and come hang out with me on December 30th. You will not regret it. I promise you that. Your time will be well spent in that webinar, learning the covered call, maximizing the covered call. And yes, I will take time at the end of the webinar to answer any and all of your questions because I love our community. My last thoughts are just Merry Christmas and Happy Holidays to absolutely everybody in our community. Our Trading Justice listeners, the Tackle Trading Pro members, our greater community at large. We have such love and respect for every single one of you. And we're so thankful of our entire community, and thank you for being the best part of tackle trading and trading justice. And I just hope you all have just an absolute great, amazing, wonderful holiday season. Merry Christmas, everybody. Have such beautiful times with family and just love one another and enjoy everybody and all of that jazz. But Merry Christmas and Happy Holidays, everybody. What about you, Chucky?
Yeah, listen, remember, it's a shortened trading week. Obviously, markets closed on Wednesday with Christmas, but half a day on Tuesday. Probably not going to be a lot of liquidity out in the market. Right? And so maybe some wider moves on some stuff. But look for those patterns. Right? Yes. Look for those patterns.
Last question, then I'm going to sign off. Is Santa Claus coming to town for the market? Do we get the Santa Claus rally? Yes or no?
Yes, we do, because Bears tried to front run Armageddon. That would be my take.
Santa doesn't care about the logic. Yes, we do, is what you said. Have a great week, everybody.
Have a great week.